The pharmacy counter is ordinary. Fluorescent light, a white bag, a number on a screen. A patient slides an insurance card across for a medicine the doctor already named. The pharmacist types. The claim returns with a copay, a rejection, a cheaper substitute, or an order to fill it somewhere else. The patient negotiated none of that. The physician negotiated none of that. Between the manufacturer that printed a list price and the person who will swallow the tablet, another firm has already ranked the drug, ranked the pharmacy, and written the arithmetic. Health plans hire that firm on purpose. They hire pharmacy benefit managers to run the drug benefit, to process the flood of claims, to bargain so a prescription budget does not become a wildfire. That is the cost control story a benefits office can defend. Then the same intermediaries take their seat in other rooms of the same transaction. A drug maker can send money backward as a rebate. A plan can be billed one figure while a neighborhood pharmacy is paid another. Scripts can tilt toward a pharmacy that shares a corporate parent with the manager of the benefit. The contradiction is not a rumor, it is a structure. An agent retained to restrain spending can also be paid from the shadows of that spending. At the counter, the exchange looks like a sale. It is not a sale. It is a claim moving through rules the person holding the bag cannot see. A preferred column, a network flag, a copay that may refuse to explain itself beside the number printed on the bottle. If the middle is only a clerk, the country hired a clerk. Pay a processor, trim a little waste, close the books. If the middle can make one medicine easy and another painful, bless one store and starve another, and show each party a different invoice for a single pill, then cost control and extraction share a hallway. This film walks that hallway, not a biography of a logo, a payment chain, from rebate to formulary to network to the refill that never leaves the family. Health plans still sign because bargaining alone looks like a Tuesday no office wants. Once the intermediary is inside the claim, whose cost is actually being controlled? When the work begins, it is almost dull. American health plans in the late 20th century drown in paper. Every prescription is a miniature invoice. Someone has to confirm that the patient is covered, apply a copayment, send money to a pharmacy, and keep fraud from chewing through the budget. Companies that can do this for millions of lives call themselves pharmacy benefit managers. They sell themselves as plumbing. Plumbing becomes a gate. By the 1980s and 1990s, employers and insurers push drug spending inside a fence. Manufacturers hunt volume that does not depend on a single doctor's habit. The benefit manager offers a new object, a formulary, a ranked list of covered medicines. This molecule is preferred. That one requires prior authorization. A generic will be substituted unless a physician fights. The list does not read like a textbook. It reads like a turnstile. Drug makers study the turnstile. Out of that study comes the rebate. The manufacturer agrees to pay a retrospective sum, usually contingent on formulary rank and on the volume that rank produces. The carton can still carry a climbing list price. After the rebate, the net price paid by the plan may fall. The patient at the register may still owe a copay or a coinsurance carved from a number the rebate never visited. One bottle, several prices. Only one of them is printed where a human hand can see it. The arrangement has a rational core, and the core is easy to miss if you start with fury. A plan that faces thousands of products cannot run a separate auction every morning. It hires a specialist to concentrate demand and force manufacturers to bid for access. Generic substitution, step therapy, and 90-day supplies are not invented for a scandal. They are tools that can drop the unit cost of a mature molecule. A benefits director who refuses those tools will eventually explain a spike to a chief financial officer. Then the tools grow teeth. As brand name list prices rise, the rebate attached to a preferred ranking becomes a larger river. A manager compensated as a share of that river can have an incentive that does not point automatically at the lowest sticker. A manufacturer that needs the preferred column can fund a fatter rebate by lifting the list. The plan, if it is shown the net, may still call the deal a savings. An uninsured buyer, or an insured buyer whose coinsurance tracks the list, may meet that list like a wall. Medicare turns the river into a sea. In 2003, Congress enacts the Medicare Modernization Act. In 2006, Part D begins covering outpatient drugs for older Americans through private plans rather than a single national pharmacy. Those plans hire benefit managers to assemble formularies, negotiate, and police utilization. A public expansion of drug coverage does not erase the intermediary, it feeds the intermediary more claims. Self-funded employers walk the same road. A benefit staff of a dozen people cannot bargain with 100 manufacturers and tens of thousands of pharmacies. They buy a manager the way they already bought a hospital claims administrator. The purchase feels like adulthood. Watch the hardware of the era: a plastic card with a routing number, an electronic switch that accepts or rejects a claim before the pharmacist has finished the sentence, a quarterly reconciliation file that never appears on the paper stuffed into the bag, a mail order plant that ships a 90-day bottle without a conversation on Main Street. Later, a specialty counter for injectables and infusions whose invoice looks like a car payment. Mergers follow the logic of any network that sells access. More covered lives mean a harsher conversation with a manufacturer. A stricter formulary means a cleaner promise of market share. Pharmacies that cannot afford to leave the network swallow reimbursement terms they would never draft. Each combination is announced as efficiency, scale, integration, savings. Each combination also pushes more prescriptions through fewer lists. The blind spot is not that Americans failed to notice drug prices. They noticed. The blind spot is the gap between a list, a net, a billed amount, and a reimbursed amount. People treat the copay as the price. The copay is a downstream fragment. Upstream, a ranking was sold. A rebate was booked. A pharmacy was paid on a formula the customer will never be handed. So the paradox at the register is not a sudden glitch. The country hired clerks to tame a messy benefit. The clerks learned that the list was more valuable than the claim. The list learned to collect. And once enough lives depend on one list, the list stops looking like paperwork. It starts looking like the market. Meet the parties who share one pill and do not share one incentive. The plan sponsor speaks first in the contract, even when the patient never hears the voice. It is an employer, a union trust, an insurer, a Medicare plan. It seeks a number it can budget, a per-member drug cost that does not humiliate the finance committee. It prefers fewer complaints than last year. It seeks someone else to fight the manufacturers. It does not, as a rule, want to own a warehouse of injectables. So it hires a manager, and it judges that manager by reports the manager often helps to write. The manufacturer sits on the other side of the rebate table. Its obsession is access. A drug that misses the preferred column can lose a decade of research in a year of switches. So the firm sends a team whose job is not chemistry. The job is placement. List price becomes a chip. Rebate becomes a chip. Copay assistance becomes a chip. If a higher list funds a higher rebate that buys a better rank, the team will consider the climb. The climb is not madness inside that room. It is a bid. The pharmacy is not one creature. A national chain can trade volume, front store soda, and a clinic lease against a thin reimbursement on a generic. An independent pharmacy on a county square lives or dies on the reimbursement for that same generic. When the reimbursement lands below acquisition cost, the independent is not having a branding problem. It is having a going concern problem. Specialty pharmacies, often owned inside the same corporate family as the benefit manager, handle the rare and the expensive, the claims that look like rent on a small building. Now, the families. CVS Health can house a benefit manager, a nationwide retail fleet, and a major insurer under one annual report. United Health Group can house a benefit manager inside Optum beside a vast insurance enterprise. Cigna can house Express Scripts beside its medical plans. Other managers remain in the market, competing for the lives the largest families do not already touch. The point is not a cartoon of a single puppet master. The point is a balance sheet that can earn from the benefit, from the fill, and from the premium. Watch a few decisions that are not theoretical. A committee can drop a medicine from the preferred column and watch prescriptions migrate in weeks. A network team can designate a narrow set of pharmacies for a class of drugs and watch independent stores lose the profitable claim. A specialty rule can require the patient to use a mail pharmacy that shares a parent with the manager. A prior authorization can delay a start of therapy until a cheaper alternative is tried, which may be prudent medicine or a wall, depending on the molecule and the delay. None of these moves requires a villain twirling a mustache. Each move has a memo. The memo speaks the language of utilization, quality, and savings. The independent pharmacist reads the same move as a steered script. The manufacturer reads it as a hostage negotiation. The patient reads it as a phone tree. Payment methods do the quiet work. An administrative fee looks clean. A share of rebates looks aligned with bargaining until the share grows with the list. A spread between what the plan is charged and what the pharmacy is paid can reward a manager for a wider gap rather than a lower absolute price. Ownership of the filling pharmacy can reward a manager for keeping the script indoors, even when a local store is closer to the patient's bus route. The patient is the character with the least paper and the most skin. The patient needs the drug the clinician named without a week of hold music, at a number that does not force a choice between the bottle and the rent. The patient is told this is insurance. Insurance here is a set of gates. Ambition in this market is not a speech. It is a desire to be the unavoidable switch. The firm every manufacturer must call, every pharmacy must join, every plan must hire because every other plan already did. That is not a secret plan. It is the ordinary dream of a network business. The danger is ordinary too. When the same dream sits on more than one side of the claim, motive stops being a single arrow.
July 2024. A Federal Trade Commission press office releases an interim staff report on prescription drug middlemen. Not a verdict from a courtroom, a staff analysis. The distinction matters, and the report's own posture requires it. Investigators and economists put language on incentives and on potential effects. They do not hand the public a stipulation that every contract in every county lifts every copay. They do put a concentration figure on the table that a non-expert can feel in the chest. The 6 largest pharmacy benefit managers in the United States handled more than 90% of prescriptions in 2023. Read that again, slowly. Not 90% of a niche, prescriptions. The ordinary fills at ordinary counters. The staff report does not stop at a pie chart. It traces how concentration meets vertical integration. Benefit managers woven into insurers, into mail pharmacies, into specialty pharmacies, into the stores on the corner. It describes formulary influence, the power to make a medicine easy or expensive to reach. It describes effects on pharmacies that must accept the network or watch the parking lot empty. Potential, incentives, staff. Those words are not decoration. They are the legal temperature of the document. Anyone who turns the report into a blanket accusation that every manager is a thief has left the paper. Another building, another voice. The Government Accountability Office studies how selected states regulate pharmacy benefit managers. The GAO is not writing a thriller. It is writing what the firms do in language a legislature can use. Benefit managers administer prescription benefits. They negotiate rebates, they affect drug pricing, they reimburse pharmacies. Among those reimbursement arrangements is spread pricing. States would not be writing statutes about a clerk. Lawmakers from both parties, in different capitals, start treating the contract as a thing that can hide a price. Some states move to restrict spread pricing. Some demand disclosure of rebates. Some try to define a fiduciary duty, a sentence that would force the manager to put the plan's interest ahead of its own when the two diverge. Each statute is a confession that the market, left as a stack of confidential exhibits, did not explain itself. Hold the two portraits side by side, and do not sand the edges. The GAO portrait is a function. Plans hired these firms to run a benefit that had become too complex to improvise. Rebate negotiation is part of that function. So is the ability to move utilization toward cheaper molecules. A country that erased the function overnight would not wake up inside a simple retail market. It would wake up inside a mess of list prices with no organized bidder. The FTC staff portrait is a warning about what happens when the function concentrates and then integrates. If the same corporate family designs the formulary, owns the insurance risk, and owns the pharmacy that fills the expensive claim, the family can be right in one ledger and extractive in another.
A pharmacy outside the family can be reimbursed at a rate that makes the fill irrational. A manufacturer can be told, without a raised voice, that access runs through a single door. The climax is not a raid. It is a collision of incentives that never fully resolves on camera. A traditional spread contract can make the manager's margin a function of the gap, not of the lowest achievable price.
A pass-through contract can promise to hand rebates and pharmacy prices through to the plan and charge a visible administrative fee instead. Employers spend years and consultants spend fortunes arguing about which piece of paper they actually inhabit. Some plans receive most rebates, some share them, some never see the true pharmacy reimbursement. The variation is the point. The market is not one crime, it is a stack of bargains with unequal flashlights. Independent pharmacies bring lawsuits and testimony about being paid below the cost of acquisition, about clawbacks that arrive after the patient has left, about networks that steer the profitable specialty claim to an affiliated mail facility. Benefit managers answer that they are lowering net cost for the plan, that affiliated pharmacies create convenience and adherence, that manufacturers set the lists, that pharmacies can refuse the contract. Each sentence can be true in a room and insufficient in the next. Patients experience the collision as trivia that is not trivia, a copay assistance card that suddenly does not count, a requirement to fill a cancer-supportive drug by mail. A preferred brand that is not the brand the specialist wrote. A generic that should be cheap and is not at this counter on this day under this plan. Do not flatten them into a single victim story. A patient on a generous plan with a low deductible may benefit from a brutal rebate deal the uninsured person cannot touch. A patient in a rural town may lose the last local pharmacy because the reimbursement math no longer works, and then pay with travel. Distribution is the plot. Regulators feel the same split. Antitrust staff look at 90% and vertical stacking and see a structure that can harm rivals and raise barriers. Health policy staff look at rebate tools and generic steering and see a rare lever against manufacturers. State insurance departments try to police a contract they are often not given in full. Congress holds hearings, interim reports multiply. The payment chain continues to run at the speed of a switch. And then the wound stays open. Because the cost control function documented by the GAO does not cancel the concentration and conflict concerns documented by the FTC staff, and the staff's qualified language does not cancel the function.
The country is trying to decide whether it hired a bargaining agent or grew a second set of sellers inside the bargain. The honest sentence is unsatisfying, which is why it is honest. Pharmacy benefit managers can lower a plan's net drug spend and, in the same year, recoup value from rebates, from spreads, from affiliated fills in ways the patient cannot audit. That dual possibility is not a verdict on every contract. It is the reason the contracts became a public question. No neat hanging, no confession under a street lamp, only a stack of official paper that refuses to collapse into a slogan, and a market that still prices most of its pills through the same handful of desks.
There is an old problem hiding inside a modern switch. If you hire someone to buy for you, you want that someone to fear a high price. If you then let the buyer keep a fraction of every shadow in the price, every retrospective payment, every gap between invoices, every fill steered indoors, you have hired a buyer who can also harvest dusk. The harvest is not always theft. Sometimes it is a fee the contract allowed in daylight. Sometimes it is a rebate share the plan accepted because the net looked pretty. Rationality here is local. Each clause can be defended in its own room. The weirdness appears only when the rooms are stacked. That is the principle this market keeps teaching, and it belongs to prices, not to sermons about virtue. A price is supposed to be a meeting. Seller, buyer, a number, a good. The prescription chain multiplies meetings until no single number can carry the truth. List is a meeting. Net is a meeting. Build is a meeting. Reimbursed is a meeting. Copay is a meeting with a tired person who still needs the tablet tonight. When an intermediary can attend several of those meetings at once, the intermediary becomes a kind of weather. Everyone else packs for a different forecast. Opacity is not a mood, it is inventory. Confidential rebate exhibits, unpublished pharmacy rate tables, specialty steerage rules written in a portal a patient will never open. These are assets if your margin lives in the difference between what two other people think the pill costs. Shine a light on every difference, and some of the margin dies. That is why disclosure statutes feel like violence to one lobby and like oxygen to another. They are not arguing about manners. They are arguing out whether the inventory of not knowing will still be allowed to exist. None of this makes the original hire foolish. A plan that faces a catalog of patented molecules without an organized bidder is a plan that will be priced like a tourist. Bargaining agents exist because manufacturers are not shy. Utilization rules exist because a pure retail instinct will fill the most advertised bottle. The strange result is not that the United States invented middlemen. The strange result is that the middlemen became large enough and integrated enough to be a second manufacturing of the price.
Imagine, only as a hypothetical, a future contract written on a single page the patient could read. The net the plan paid, the sum the pharmacy received, the rebate that moved backward, the fee the manager kept, the name of the affiliated fill if there was one. No helicopters, no crowds, just a page. Some of the weirdness would evaporate. Some of the bargaining power might evaporate with it if manufacturers refuse to bid in public. That trade, transparency against leverage, is the live argument. And it is an economic argument, not a ghost story. The aftertaste is a plastic bag and a number that was never only a number. Someone, somewhere, optimized. The optimization may have saved a plan. It may have shrunk a pharmacy. It may have moved a patient onto a molecule a rebate preferred. It may have done all three before lunch. The mechanism does not need a mustache. It needs a residual claim on a difference. So the haunting question is not whether middlemen exist. They exist because plans hired them. If the same desk can bargain down a manufacturer, reimburse a pharmacy, rank a medicine, and fill the bottle, whose saving is the real product, and who is paying for it?